You don't need to flee Massachusetts in retirement. I'm telling you, I did a video like this on California, and I'm going to do one in Massachusetts here. Now, look, there's lots of reasons to get out of Massachusetts. I get it. Taxes aren't one of them. I'm telling you right now, I'll prove it to you. So let me make sure I'll pay, buddy. So Meg writes in, a wonderful lady here. She says, I've been watching your videos on Roth conversions, and I got to watch them again. Just all of them are so great. You have set me at ease. She just started watching Ty and Talit McNeely on Crush Your Mortgage channel in March. Hold on just a second. Let me get this guy. There we go. And they've been a big help to her to crush her mortgage, which I like. She's old Meg's 58. She's going to work for the next 10 years or so. She was worried about how far behind she was. And then she saw my video on retiring on 350 or less and made her feel so much better, although she does plan on crushing in the next 10 years. All right. So she's going to, over the next 10 years, then she said, let's see, I never knew about Social Security tax on IRAs or property tax. I've learned so much from you in 2 weeks. I live in the most beautiful coast ever in Massachusetts, Bruin territory. Yay, Boston Bruins in the house. But they've lost 2 straight. Scary. Of course, the Pats have lost 2 straight. Scary. Let's see. She's got about roughly 300, a little bit less than 300,000 on her mortgage, and basically roughly a $500,000 home. All right, so let's go into this. We're going to say old Meg, and she's making pretty good money now. So she wants to pay off her mortgage by the time she retires, which is freaking awesome. So just for simplicity, if she had $300,000 in mortgage, that's going to cost her roughly $1,500 a month in principal and interest. For every $100,000 in mortgage, the rough estimate is about $500 a month. Every $100,000, that's it. Every $100,000 in mortgage, the rough estimate is about $500 a month in payment. All right, so if she had a $300,000 mortgage, and that's principal and interest, and she were to pay that guy off, that means there's $18,000 a year she doesn't have as a mortgage payment. What else does that mean? That means there's $18,000 a year of income she doesn't need to generate in which to pay that mortgage. But there's more to it. That means there's $18,000 of income she doesn't have to pay tax on. So you see the benefit of paying off your mortgage? Not only do you not have the $18,000 a year going out the door, but you don't need to raise income. You don't need to pay taxes on $18,000 a year in which to raise the money to pay the mortgage. It's a twofer. You keep the outflow down, and you keep your taxes down by paying off your mortgage. So look at Bob, he's sleeping. See him? See his eyes right there? I just love this dog, man. Is there anything better than a dog? I love you, Pablo. Oh, look. Oh, man, I love him so much. All right, so she'll have her mortgage paid off. That's going to save $1,500, $1,500 a month, $18,000 a year. All right, now part 2 of this. When you live in the Northeast, you're mostly making more money than us living in the South because the Northeast is more a costly state to live in. So we'll just say, in this case, she's at the maximum for Social Security. So we're going to say she gets $3,000 a month at her full retirement age of Social Security. All right, then we're going to say she has $3,000 a month of other kind of income, be it from a pension, be it from her retirement account, something like that, whatever it might well be. So we're going to say she's going to have $72,000 a year of income, gross income coming in. Does that make sense? So $3,000 a month from Social Security, $3,000 a month from other sources of income. That might be high. But just let me show you. So that's $72,000 a year coming in, of which half is from Social Security. The mortgage is paid off, right? So there is no mortgage, so she doesn't have the $18,000 a year going out, but she still has property tax. Because Massachusetts property taxes are higher than most states. So we'll just say it's $1,000 a year in property tax. So what we're going to do is we're going to say, let's go to my website. Hold on just a second. Had to make sure I didn't have any almonds in my teeth because that'd be kind of yucky. All right, so we're going to go to heritagewealthplanning.com. We're going to go to tax tools here. All right. And we're going to click on interactive tax page. And then we're going to kiss Pablo. So we're going to scroll down to state tax tools, smartasset.com. We're going to click on Massachusetts. There we go. All right. So we're going to say old Meg is born in 1955. She's single. She has $3,000 a year from Social Security and a month from Social Security and $3,000 a month from other income sources. That's $72,000 a year. she's going to pay all of $1,600 to the state of Massachusetts for taxes. That's it. And if we scroll up here, Massachusetts fully exempts Social Security retirement benefits while taxing most of other forms of retirement income. Now, the drawback about Massachusetts is the estate tax. That's bad, but still, at the end of the day, from an income tax perspective, it's $1,600. That's it. That's what, $125 a month or something like that? Not a big deal. Now, the feds are always a big deal. So the feds right there, $5,800 on $72,000 a year. So we'll just say that she has $1,000 a month in property taxes, plus, which is $12,000 plus $7,400. That's almost $20,000 a year of taxes. But that's so her net income after taxes, because she's making $72,000 a year. 20's got to go out to taxes for property tax and Commonwealth of Massachusetts and federal income tax. It's still $52,000 a year. All right. Now she has that mortgage, $52,000 a year. All right. Her utility bills, we'll say $500 a month, which I guarantee they won't, but that's $6,000 a year. So it's $46,000. She still has disposable income. I mean, look, I'm not saying you're going to live long. I don't know. I mean, that seems like pretty good income to me. If you have no mortgage and you've already had your taxes factored in there, that seems like pretty good. Seems like you can live pretty good on that kind of money. But so you're going to flee Massachusetts to save $1,600, and yet what are the property taxes in Florida versus Massachusetts? And they're going to be a little bit lower, I presume, but not significantly lower, because Florida also has they have homeowners insurance that are much higher than Massachusetts because of all the hurricanes that go through there. So you don't need to flee Massachusetts. Social Security is not taxed. Withdrawals from retirement accounts are fully taxed at 5.1% in terms of IRA distributions because of the flat tax rate. Again, the thing about Massachusetts is the estate tax for sure, but you just don't need to. I hope that's clear, Meg, because, I mean, look, you obviously love it where you are. You love Massachusetts. There's absolutely no reason you have to flee there, unless you're afraid of the cold, which I get, but still, you can still domicile there and just go to the South for a couple months a year. Nothing wrong with that. Hope this helps. Do not get caught up in the thing like, oh my goodness, the taxes are going to kill me. It's the property taxes is the big one, but the federal income tax is much bigger. And on top of that, it's the housing expense, the mortgage. I'm telling you, if you have no mortgage, you can live in any state you want for sure. All right, we'll see you.